Welcome back, guys. Today we're going to take a look at Solvay because somebody requested it. Now, this is a company that's in the chemicals industry. It's also a British company, so it's all these numbers are going to be in British pounds, different from dollars, I know, but the British pound is pretty stable. It's usually got about the same inflation rate as the dollar, so it shouldn't be too much different. And so we're just going to take a look today. Now, over the past 5 years, we're up 46% on this stock, and they also pay a 4% dividend, so actually not bad performance at all. Just barely lagging the S&P 500, so that's really, really solid. Also, their valuation is pretty attractive according to the numbers that I looked at, but something that you won't see in this chart is they actually sold off a large part of their business right around here, and so yeah, it doesn't show up in this chart because they like normalized it somehow, but you'll see it in their balance sheet. I can actually show you in the over-the-counter market. You can see, yeah, right here, this massive drop. They had sold part of their business and then they paid it all out in a special dividend. So that's why you get that massive drop. But yeah, back to this one. Taking a closer look. Now, a lot of these numbers are not going to be super useful. Yeah, their total revenue declined. I'm not quite sure if this is normalized for their sale of the business or not. And yeah, you can see right here, discontinued operations. This is how you know that they sold part of their business. Well, they made $1 billion and $2 billion from discontinued operations. So that's a sale of part of their business. And you can see it on their balance sheet as well. Their balance sheet dropped from 20 billion down to 7 billion in total assets. So not quite sure if selling off part of their business was a good strategy. Obviously, there's a reason that they did it, so probably was a good idea. I mean, according to management, I'm sure if you ask them, they'd say it's a good idea. So anyway, I do take their net debt from their latest quarter, so I'm going to use that in the model that I have. And in terms of cash flow, I'm guessing that this cash flow is not going to continue because right now they're valued at 3.5 billion, and with a cash flow of 800 million, that would be a price to cash flow yield of like 5, and that's extremely low. So I don't see that continuing. And yeah, you can see in the last quarter they only had 83 million in free cash flow. So if you extrapolate that a little bit, you're looking at like 300 or 400 million in free cash flow, which makes a lot more sense than 800 million. Yeah. Let's look at the stats. Let's look at their margins here. Their return on invested capital is okay. It's not great. Their net margin for the latest quarter was 8%. So we're probably going to end up using 8%. Their gross margin is 22. We're looking at between 5 and 10% over the past few quarters. They had a negative 20 here, probably because of unusual expense, but yeah, the gross margin is pretty stable. The EBITDA margin is very stable, so we can use those numbers probably. Let's look at this. So a little bit on them. They make most of their money from soda and ash derivatives. It's a chemical that they produce. That's most of it, and then they make quite a bit of money off peroxide, silica, coatis, and special chemicals as well. In terms of those markets, they actually declined quite a bit last year. However, peroxides is actually up 12%. Could be a sign of a weakening chemicals market. Not quite sure. It could be just a cyclical thing. So yeah, it's tough to analyze chemicals unless you actually know a lot about them. In terms of their latest quarter results, they have capacity expansion, I guess, and they have new products that they developed, and they have some cost savings initiatives that are already bearing fruit according to them. And they have a $1.5 billion or pound bond placement. Not quite sure what this means, but that's what they say. Anyways, the analysts are going to be our biggest help on this one, so let's go to them. 3.77 going up to 4.4. That's what they're projecting. In terms of earnings per share, that's pretty solid, considering that we're only trading at 34 right now. So that would be a price to earnings ratio of 10 or 9. And with that growth rate, that's insane. Also, they're projecting minus 5% this year in their revenue, which makes a lot of sense, and up 4% the year after that in their revenue. That's according to like 13 analysts, so not too bad there. And I checked the short percentage; it doesn't show up. Maybe it's just a British thing, but yeah, let's take a look at the valuation here. I put the estimates here: buybacks of zero, net debt of 1.7 billion, discount rate to 10% because I want a 10% return on all my stocks. Exit multiple of 15. Yeah, currently with them trading at like 9 or 10, I think 15 is fair. Maybe lower would be better, but yeah, I feel like chemicals are pretty stable, and you'll probably just get like regular growth with these. So let's so I plug the numbers in, 2% growth in their earnings. I feel like that's fair for this business. I mean, it's a little bit cyclical, so it's possible that some of these are negative and some of these are like positive 12. But I think overall, in the long term, they'll grow at 2%. So in this case, they are worth about $34 after all their debts, and yeah, and usually with companies that are very stable, usually chemicals are pretty stable, so I'd probably put their fair share price around 45 according to this model. But of course, maybe I'm missing something. I could definitely be missing something. So I won't put too much stock into this one. Also, the revenue model. They're projecting 4% growth moving into 2025, so that's what I put, and then just a growth of 2% after that. And profit margin, they're projecting 8%, so that's what I put. And I brought them down to 7%, more of a historical average. They say they're cutting costs, so maybe they get their profit margin up to 8 or 9%. But I feel like 7 is pretty conservative for this company. And in this case, their fair share price is going to be between 27 and 45. After all debts are paid, then it's 27. So actually not too bad. Like I wouldn't be opposed to opening up. Well, I probably wouldn't open a position in this just because I don't really understand it all that well. Maybe if I understood the chemicals industry or maybe the British like companies a little better, then I would invest in this. But it's not for me right now. So, but let me know what you guys think in the comments and make sure to hit that like button. I'll see you in the next video.